All right. Hello, everyone. So this is going to be regarding understanding insurance. I believe in order to become a good advisor and also in order to understand the four modules, the material, and also, basically passing the exams, it's really important that as a foundation, you understand how insurance works. What we're talking about and what we mean about that is that it's really important to understand what is the relationship between the agent and the insurance company, the client and the insurance company. What are some ground rules that always apply to any insurance application, right? And all those kind of, good stuff. So in this video, we are actually going to be talking about how insurance works. We're going to understand the insurance process. And I am going to be giving a lot of examples. If you pay attention to this about 1 hour video, I hope it's going to be 1 hour, not more. I will guarantee that understanding the modules and passing your exams is going to be much more convenient and easier. All right. So let's start with that. I want to say that before we actually get somebody insured, a client, there are a couple of important tasks that as an agent we have to do. First thing that we have to do is that we have to speak to them and we have to understand what their needs are. And also, we have to understand their situation. If you are an advisor, your job is to advise based on their situation. And this is something that's really regulated. And for compliance reasons, you always have to have a summary and a document about what you have talked to and what the client has shared to you regarding their situation. All of that happens in a form that we call the FNA. All right. Financial needs analysis. I'll try to be as good as possible in my handwriting, but I can't guarantee. All right. So financial needs analysis. I'll write it down for everyone. All right. So in this financial needs analysis, we're going to understand how much is their income, how much is their expenses, what debts do they have, what investments do they have. Um, Also, we're going to understand about their dependents, their co-applicants. We're going to understand about their goals. Like when do they want to buy a property? When do they want to go for vacation? When do they want to get retired? Right? When do they want to have children? So all of these are important. How much money do they need for emergency? Right? All of these are actually so important that we have to basically understand them from the client, right? And all of that comes in from a financial needs analysis. Now, after the financial needs analysis is done, there should be a recommendation based on that. So usually, we take a couple of days as an advisor and we, analyze all these informations that we got and we get into a decision that what is recommended for this client. Now, let's say in this case, we are doing this for Peter, all right? And Peter gives us the information on the FNA. As an advisor, we get back to them and we have a recommendation that they need a life insurance worth $1 million. And this $1 million of life insurance for Peter is going to be costing him a premium of, let's say, $400 a month. All right. I'm making it really simple. We're not going into the details of what type of insurance it is or stuff like that. Um, but what's important is that we are actually looking into what is beneficial for Peter and also how it's going to look like. So now Peter understands that based on the needs that he has, based on his financial situation and his goals, he needs $1 million of life insurance. And that $1 million of life insurance will probably cost him $400 a month. Why am I saying probably? Because it's not guaranteed. Peter has yet not been evaluated by an underwriter. He has still not become approved for a life insurance. All right. So nothing is guaranteed. This is just the recommendation based on if Peter wants to apply for a $1 million life insurance, a specific product, it should probably be $400 a month. All right. Now, this is called illustration. So illustration is what basically gives you a projection, an overview of the insurance policy that they're potentially going to purchase. What is it going to cover? What are the exclusions? What is the time frame of this policy? What are the benefits of this policy? How much is it going to cost? And all the other good stuff. But this is just a projection, all right? So this is really important, guys. This is not the policy itself. Now, one thing that you have to do is that when you had these sessions with the client, all right, there's a couple of forms that you are mandated to get a signature from the client to make sure that, they approve that we had this discussion. One of them is the FNA. So the FNA has to be signed by the client, so they approve that this is the right information. Another one is actually the illustration. The client has to sign the illustration to say that, okay, yes, I understood this illustration. It's been, basically told to me, and we got to this conclusion. Another one is called a reason why letter. So a reason why letter is basically that part that we will explain to the client, Peter, why did I recommend $1 million of life insurance for you? So based on what you told me in the FNA and the discussions that we had in the meeting, I recommend a $1 million life insurance of, let's say, a whole life policy, which will cost you about $400 a month. And these are basically the check marks of what it's going to be covering and how it's going to be covering your needs. All right. So all of that happens in this type of letter, which is called the reason why. Now, there is another important form which could actually, if you don't follow it, it is going to put your license in danger. And that is what we call the LIRD form, Life Insurance Replacement Declaration. Let's say if Peter already had a life insurance, okay? Let's say if he had a life insurance of $100,000 paying $100 a month. Peter comes to you, and in that FNA, we understood that, okay, he does have some life insurance. Now, what I'm going to advise Peter is that, Peter, it's better that you cancel that policy, and I recommend you getting this $1 million life insurance policy that I just suggested. Now, because Peter already has a life insurance, and is basically our recommendation is that they have to cancel it, there has to be some strong reasons of why we want to do this. All right? Because a lot of times, maybe an insurance advisor wants to get commission, and they only get commission if they sell you something. And because the client already has life insurance, it doesn't make sense to them that why do I need to buy another life insurance policy? The client and also the compliance department, which would be CCIR, which we'll talk about it in the ethics module, they have to make sure that there was a beneficial reason for the client that this replacement is being done. So in this LIRD, we have to talk about the advantages and the disadvantages of replacing their policy. So if you have a client, if it's just an addition, let's say Peter wants to keep his $100,000 life insurance and you are adding another $1 million to it, that's okay. But if Peter, and based on our recommendation, is going to cancel the $100,000 life insurance and then purchasing that $1 million life insurance, the LIRD form has to be written, it has to be signed by the client. So all of this is done before actually applying for any life insurance, right? Or maybe it's an accident sickness insurance, or maybe, it's a segregated fund. Right now, we're not talking about that. We're just going to go by default as a life insurance, but this actually constitutes all different type of products that we, offer. So the FNA, the financial needs analysis, the illustration itself, the reason why letter of why we recommended this, and also if it's a case of, basically replacing a life insurance policy, we have to do the LIRD as well. All right, wonderful. So let's go into this part that we want to start. Let's say Peter right now agreed with the $1 million life insurance of $400 a month. As I said, nothing is guaranteed. He still has to go through the approval phase. We don't know if it's exactly going to be $400 a month. We even don't know that insurance company is going to approve the $1 million coverage. Maybe they're going to cover less, or maybe they're not going to cover at all. And we don't know if there's going to be any exclusions, right? So right now, we're just going to do the application form. All right. So in this case, we do have a client, right? Now, the client is not directly in touch with the insurance company. Basically, what they're doing is that they're in touch and connected with the agent, right? So after everything is done, the client has to fill the application for the insurance policy. So this is really important. Who fills in the application? It's the client. Maybe sometimes you see, based on experience, that the advisor is filling in the application, but they're not filling in the application as giving the answers. They're just helping the client. So the client is giving the answers and you are filling the application for them. So technically, it's the client that is filling the application. And when they fill the application, obviously they have to sign it and then we'll pass it to the agent. Now, the agent is going to review it, making sure that everything, has been read and everything is complete, and they're going to sign it as well. And then the agent is going to submit this application to the insurer. So the insurer is the organization or the company that is going to be, basically insuring that potential client, right? Now, what does the insurer do in this case? The question is this. So the insurer gets the application, receives the application with all the documents, and obviously there's a lot of information in the application. What are the information? Who is that person? So first of all, the ID and everything. What is their financial status and what is their job? Like who is their employer, or if they're self-employed or whatever. Um, they want to know about their medical history, so they're going to ask a lot of medical questions. Also, they want to know if this person is exposed by any political person, right? Like maybe their cousin, their brother, their father is a political person. They want to know where is the source of funds coming for this policy, the premiums. They want to know where this life insurance is actually going to be helping this client when they pass away. So, like, is this for, paying off a mortgage? Is it for legacy? Is it for their business? What is it for? So they want to understand that as well, right? And that financial part is actually important as well. So we're going to talk about exactly what they're doing. But what I'm trying to say is that in the application, there's a lot of information that they gather. Now, the insurer takes all of this, and what they want to do is that they want to review it and see if we are going to approve this person or not, right? Now, how does that happen? That actually happens by something called underwriting. So there is an underwriter department, or sometimes this is actually a third party. So like the insurance company is insurance A, let's say, and there is an underwriting company that they actually sign a contract together. The underwriter is responsible for doing this review. So either an insurance company has their own underwriting department, or sometimes they just do it through a third party. So I've noticed, like, for instance, TD insurance or car insurance, which is completely, um, out of our topic, but they actually underwrite 3 or 4 other insurance companies as well. They're the underwriters for 3 or 4 different insurance companies. So it doesn't mean that they only underwrite their own applications for TD insurance. They actually have contracts as a third party for other insurance companies. It is the same thing in life insurance as well. So the underwriter is going to review the policy and the application, basically, right? What is it that the underwriter is going to be looking into? I would say there's 4 different topics that is really important. First of all, is the application itself. So they want to know the application has been completed accurately. Nothing is left behind. Everything is there. That's one thing. Wonderful. Who is this person? The ID and everything. They want to check that. And then after that, they're going to go into the medical. So the application part is actually important as well. Why? Maybe this insurance company would not cover Peter if he is above 50 years old or above 60 years old, right? So they have to know about the person as well. Now let's dig into the medical part, which is one of the most important parts. And obviously, a lot of questions come from this part, okay? Now, when the underwriter wants to actually gather information regarding the medical situation of the client, and it matters a lot, right? Because just think about it. A simple example is that the client had cancer or that didn't have cancer, right? It makes a huge difference in approving or declining a client. Now, in order to do that, there's 4 sources that the underwriter should have access to in order to find out what the medical situation is, right? Like life insurance is all about risk. We're going to talk about that in the life insurance module after this video. But the most important thing is about the risk of insuring the client. Obviously, the insurance company wants to know that the chances of this client staying alive for a certain amount of time is high enough that they're going to get the premiums, and based on the premiums, they're going to make enough profit that they're going to pay out the life insurance as well, the death benefit. So they want to make sure that this client is healthy, right? Now, the first way that they can actually, you know, analyze the health and the medical situation of the client is the application itself. All right. So this application, and as I mentioned, there's a lot of medical questions in it. All right. Like, who is your family doctor? When was the last time you visited and why? In the last 5 years or in the last 10 years or in your whole life, did you have any of these symptoms or any of these, basically diagnosis? There's going to be a lot of these questions. Even there's going to be family history as well, like your immediate family, your father, your mother, your, siblings. Did they have any, specific diagnosis or medical concerns as well? Is there any medication that you're taking? Regarding drinking, regarding smoking, and all of that, there's going to be questions as well. So based on the application itself, the underwriter can get a great understanding about, okay, where does this client stand, right, in terms of health. But sometimes, the underwriter feels like they need more information. They can't just rely on the application itself. Maybe it's because the client haven't visited a doctor for a long time, right? Or maybe there are some answers to the application that made the underwriter curious that, okay, I need more information about this. Or maybe the client is actually a newcomer, right? They just landed in Canada maybe in the last year. So there's not that much information in Canada regarding this, right? So all of these situations might lead the underwriter to ask for more information. Now, the second source that they have is called MIB, Medical Information Bureau. Okay, this is really important. Medical Information Bureau is a database that belongs to all the insurance companies. So let's say insurance company A, B, C, D, right? Let's say 10 years ago, 5 years ago, 2 years ago, Peter actually did apply to insurance A for life insurance. Whatever information in the application is there, either that Peter took the policy or didn't, either that, you know, the insurance company approved the client or didn't, no matter what, whatever information that Peter has given to insurance A, it has been actually stored in a database that this database is called MIB. Now, when Peter now is basically right now applying through his agent for insurance company B, the insurance company B can actually restore those information, can receive those information from the database. All right. So basically what this means is that this database does not, I'm going to emphasize on this, does not have information about your family doctor. All right. Because it's not up to date. It has nothing to do with the family doctor or if they've been to the hospital or whatever it is. It's only the it's only the information that insurance companies have from them. So let's say if Peter has never, ever applied to any life insurance or any insurance, all right, then there's no information in the database for them. Okay. But what information could be there? Obviously, first of all, the most important thing is their insurance history. So let's say if when Peter applied um, to company A for life insurance, um, he got approved, or maybe he got declined. Maybe he got approved and then he put in a claim for, I don't know, um, I got sick. Let's say if he got a critical illness coverage from company A and he actually claimed because he got a heart attack or he got cancer. So all that information is there. So if they've been approved for a policy, if they've been declined for a policy, if even Peter stopped paying for a policy and it got canceled and it got lapsed, all of that information is in the MIB. Okay. And also any medical information that company A had from Peter is also, stored in the MIB. So MIB is a confidential database. Only insurance companies have access to it. And if somebody applies for life insurance, they can actually request that information from MIB, gather that information, and basically they can understand. If you want to see what information MIB has from you, you can actually go to MIB.com and you can request it. It's for free. You can request your information bureau that they have, whatever records that they have from you. Um, you can request it and you can look into it. And if you feel like anything is wrong, um, basically you can contact them and you can say like, look, this information is inaccurate. Um, and then they can look into that as well. All right. So this would be the part of MIB. All right. Now, let's say Peter has never applied to life insurance or any insurance in his life. So obviously the MIB data is completely, you know, um, zero, right? There's nothing in it. So there is another way that the underwriter can get more information about the medical situation of this client, which is called APS, attending physician statement. So this attending physician statement is usually your family doctor, all right? It's usually your family doctor. And basically, in this case, the underwriter will get a report of the latest medical history and condition of this client, all right? The insurance company will pay the family doctor a fee, and the family doctor will send a report to the insurance company. And the underwriter can actually review, that report. So this is the best way, and I would recommend it in cases like, I would recommend it in two cases that because an agent can actually voluntarily ask the insurance company to take the APS. All right. Um, Also, the next part, I'll actually explain the next part and then I'll tell you what times is it actually beneficial for agents to voluntarily ask for an APS. But let's say in the application, the client mentioned that, yeah, last time I went because I had some chest pain. And then the doctor said it's nothing. I did the X-ray and everything, the CT scan. It came back that everything is normal. It might have just been some, stress. All right. It's the exact same thing where the underwriter wants to make sure that what the applicant said is actually true in the application and there's nothing to be worried about. So they are going to get that information from the physician. All right. And the fourth way to get this information, the medical information, is actually the best ways. It's called blood work. Let's say that, or paramedics, they call it, whatever. So basically what it is that, insurance companies have contracts with these laboratories that they do blood work and urine tests and all of that. And they will go to, the client's resident and they will gather that information. They will do the tests and then they will give the results back to the underwriter. All right, what does that mean? That means that this, information will be completely up to date, right? If there's any, I don't know, blood pressure, if there's any cholesterol, if there's any, um, I don't know, problem with their, you know, sugar, their blood sugar and all of that, it's all going to be, you know, uh, understood, right? So it's going to give a more proof to the underwriter that, okay, everything is good. As I mentioned, the underwriter has the option and the choice to request for MIB, APS, or blood work. It's not going to happen on all the applications. It really depends, right? First of all, you know, this is a part that I wanted to say that as an agent, you can actually voluntarily ask for the APS and blood work for the underwriter. Why is that? Sometimes, the applicant is actually your friend. And he kind of teases you and says, look, you know that I don't smoke. I only smoke once in a while, maybe once in a year. So put no. Now, me as an agent, I don't have the right to argue with what the applicant wants to put in. I could basically, tell him that if you lie and they understand that you lied, they could actually deny the claim at the time of your death. But I'm not allowed to tell him you're a liar. Right? I'm not allowed to tell him, okay, no, you have to put in yes. It's whatever the applicant wants to put in. So sometimes in that situation, that you know that person personally, or let's say that you know that this person, when he drinks, like Peter, when he drinks, he gets out of control, right? And maybe once, the family doctor told him to stop drinking or reduce it, but he says, no, you don't need to mention that. That was just a full, that was just a uh, informal, um, suggestion from my doctor. It's nothing that's been documented. Or sometimes your client is actually a little bit older and there might be some risks, right? You want to take that blood work, making sure that everything is correct, right? So it depends on you that if you want to voluntarily ask for a blood work and APS as well. All right. So these are the four ways that an underwriter can basically be sure about the medical status of the applicant. All right. So application, MIB, APS, and blood work. If in a question it mentions that the client had, some chest pain or had some back pain or whatever and went to the doctor, usually what the underwriter will do is check the APS. If an underwriter wants to know their insurance history, have they ever made a claim? Have they ever had a policy lapse or insufficient funds or not paying or stuff like that? Then the MIB will be the answer, right? So pay attention to this. It's really important. There's going to be a lot of questions regarding this, both in ethics and in life insurance. It could be an accident and sickness as well. All right. Now, let's go to the third part of underwriting, which is called the financial part. Now, the financial part is really important. Let's say if Peter is purchasing this $1 million life insurance, which we mentioned that it's going to be $400 a month. All right. But in the financial questions that we had in the application, we understand that Peter is unemployed. And then there's going to be this risk that maybe Peter won't be able to pay the policy. So there's going to be a risk that the insurance company is going to insure them. And obviously, because we have something called a grace period, right? So the grace period, which is usually 30 days, um, maybe Peter will die in that 30 days without paying for the premiums, but the insurance company has to pay the $1 million, right? Also, it's not just about that, like in the first month or second month, because obviously the insurance company is going to have a lot of expenses in the beginning. They're going to pay the commission to the agent, they're going to pay the underwriter, they're going to pay, they have to make sure that they have the $1 million, they have to prove it that they have the $1 million, right? And all of that to assure us, which we're going to talk about it later. So the insurance company has to put in a lot of, investment, making sure and hoping that Peter will stay alive for a certain amount of years, paying that $400 a month. So that is the part that is really important, that the insurance company makes sure that Peter is, you know, self-sufficient to pay that $400. All right. And sometimes it's not about $400 a month. This is just an example. Sometimes it's about $4,000 a month. Sometimes it's about $100,000 a year, right? So we have to make sure that, you know, the applicant is actually ready to pay this for a long term. So we want to know how their financial situation is. All right. Another part is not just about the premiums, but it's about the coverage itself. Why does Peter need $1 million of life coverage? Okay, so they want to understand that, okay, is this $1 million actually suitable for Peter or not? Did the agent did the right thing with offering $1 million or not? Maybe Peter only needs a $500,000. Then why is he getting $1 million of coverage? Right? These could be questions asked, especially when the death benefit goes higher. Let's say 5 million, 6 million, $10 million. All right. They want to understand that. Sometimes it's about like a 20-year-old kid purchasing $10 million of life insurance. Why? All right. Financially, are they in need for that $10 million? Financially, are they able to pay that premium of, like, let's say, X amount of dollars a month? All of that is the financial part that the underwriter is going to make a decision as well. And at the end, it's compliance. So when we're talking about compliance, we're talking about, first of all, as I mentioned earlier, is this person actually himself, or is it a third party? Is it like, an attorney doing this for somebody else? Second, is he a politically exposed person, like a cousin or family member, anybody that is in a political body? We also need to know that where is, basically this fund's coming from. It's not coming from like a terrorist attack, a terrorist body or something like that. Also, we have to make sure. Is this person actually a Canadian resident? Are they eligible to purchase this policy? And all the other things like that. So that would be the compliance part. So eventually, the underwriter, now let's say if the underwriter feels like, or even the agent, because this is really important, the agent or the underwriter, any of them, and I'm talking about the agent, feels like this person is a politically exposed person. All right. So there's two times that we actually have to report suspicious activities. And who do we report to? We report to FinTrack. Again, we're going to talk about FinTrack in the ethics module, all right? But just to let you know, if this application would have $10,000 of cash transferred in 24 hours. So let's say if the premium is $10,000 and the client is actually paying this $10,000 in cash, or it's more than $100,000 anyway, not just cash, but the person is politically exposed. In these cases, the agent is required to report this to FinTrack, or if the insurance company, the underwriter, um, notices that. All right. So this is really important. But let's continue and say that, okay, eventually the underwriter makes a decision to either approve or decline the applicant. In that case, they will give the results back to the insurance company. The insurance company will either prepare the policy and send it for delivery to the agent, or give a refusal letter to say that, unfortunately, we're not able to approve you. Let's go with the part that the agent actually gets the approval for the applicant and the policy is ready for delivery. All right, what does that mean? That means now this is the actual policy. This is not the illustration anymore. In the illustration, it was a projection. But in the policy itself, it's exactly mentioning that, okay, we are going to be covering you for $1 million of coverage. Your premiums are going to be $400 a month. These are the things that we're covering, and this is what the exclusions are. All right, so everything is going to be completely written down in the policy, all the terms and conditions. All right, and then the agent sends this for delivery to the client. All right, now, when is a policy in force? When we call in force, what we mean by in force is that it's active, that person is actually insured. All right, one of the requirements for the policy to be enforced is this delivery signature. Only one. It doesn't mean that if you basically sign the delivery signature of the policy, you are insured. But this is one of the requirements to make sure the policy is enforced, the delivery signature. All right. Now, let's go into this process of who is the client. All right. So we talked about the entire process. Client, the agent speaks with them. They do a financial needs analysis. They give a reason why letter. They give an illustration. All of that is happening. The client fills in the application. The agent submits it. The insurer gives it to the underwriter. The underwriter basically reviews the policy, the application with, all the different criteria that they have to do. We talked about the medical parts, the financial parts, the compliance parts. And at the end, there's going to be an approval or a decline. If it's an approval, the insurance company will, prepare the policy documents and it will go for, delivery. Now we want to talk about who is going to be the client. The client itself are three people. So now we're going to talk about the client. So what's important is that there are three different characters in an insurance policy from the client side. All right. The first person is the policy owner or the policy payer. So what does this mean? This means that who is purchasing the policy? Who is going to own the policy? Who is responsible for paying for the policy? All right. Who is in charge of the policy? All of that is the policy owner or the policy payer. All right. Now in Ontario, they have to be 16 years or older to be able to become a policy owner. I believe in BC, it is 18. All right. It's the majority age. So it's not the legal age, it's a majority age. And the majority age in BC, I believe, is 18 years old. And in Ontario, it's 16. All right. Now, other than that, so a 5-year-old cannot purchase a policy. A 10-year-old cannot purchase a policy. A 15-year-old cannot purchase a policy. This is a really important section. I'm going to be giving a lot of information. So I do want to see everybody focus and bear with me. Now, the policy owner is not necessarily the insured. Insured is a different person. It could be the same as a policy owner, but it could not actually. So what do I mean by this? Maybe Peter is purchasing a policy for himself. All right. So Peter is a policy owner and also is the insured as well. So he is taking a life insurance policy on his own life. All right. So he is both the policy owner and the insured. But maybe Peter is purchasing a policy for his wife. In this case, we'll put her wife's name as Lucia. All right. So Lucia is the insured. So who is going to be getting, you know, um, whose life is going to be measured for all the underwriting and the application and the medical things and all of that? In this case, it's going to be Lucia. But who is the owner of the policy? Who is going to be paying for the policy? It's Peter. All right. So the policy owner payer, but the insured could actually be 2 weeks old or older. So you could actually insure a child, a newborn baby, after they pass the 14 days of being alive. All right. So we can insure a 1-year-old, but you can't make them the policy owner. Does that make sense? Wonderful. All right. So this is a difference of policy owner and insured. Let's say in the case that it is Peter insuring Lucia, Peter passes away. All right. He dies. In this case, the insurance company is only obligated to pay the death benefit when the insured passes away. This is an important note to take. All right. Now, let's actually go into the third character, and then we're going to talk about a lot of different type of scenarios, which are all so important, basically for your exams and also for helping your clients. All right. So the third character is your beneficiary. So the beneficiary is the one that is going to be receiving the money. All right. And in order to be able to receive the money, you have to be 18 years or older. Now, let's say in a case that Peter is the policy owner and also Peter is the insured as well. And let's say their son, Jack, is the beneficiary, and Jack is only 5 years old. Now, unfortunately, Peter passes away. As we talked about it, the beneficiary has to be 18 years or older to receive the money. On the other hand, Peter insured himself that in case of his, death, Jack is going to be having enough money to survive and to live. So Jack is 5 years old. There's still 13 years left until, he becomes 18. What is going to be the situation here? The situation over here is going to be that Peter had to be assigning somebody called a trustee. Okay. So a trustee is the person that is going to be the trust. If Peter passes away before Jack becoming 18 years old, the court would actually assign a portion of the death benefit to the trustee so they can take care of the expenses of Jack. So let's say in the case that it was a $1 million life insurance, this $1 million life insurance is going to go into a trust account. And then the court is going to, basically do an analysis and basically will say, okay, Jack needs $3,000 a month to survive. So they are going to be paying $3,000 a month from this trust to the trustee, whoever it is, that $3,000 a month. So the trust does not have access. The trustee does not have access to the $1 million in total. The court will, basically have a complete look on it, observe to see that, that portion of it is, going to Jack through the trustee every month, and it's actually being spent for Jack as well. So they will have, people that they go in, they review everything. All right. So this is really important. So if you have a beneficiary that is below the age of 18, because they do not get the money until they become 18, it is really important that you assign a trustee. And that trustee would actually be the one responsible to take care of the expenses of the child. And then when Jack becomes 18 years old, then the $1 million, whatever is left, is going to be, um, paid to Jack. All right. All right. Now that we understood the three characters as a client, which is the policy owner, the insured, and also the beneficiary, let's talk about a couple of things. First of all, who assigns the beneficiary? The policy owner. So who is the one that designates who is going to get the money? It's the policy owner. Who can change it along the way? Again, it's the policy owner. All right. Now, you remember when we talked about it, that if Peter dies and the insured was actually Lucia, the insurance company is not going to pay the death benefit. That is completely true. But there should be somebody that is going to become the new owner of the policy, right? There should be somebody that is going to be taking care of the premiums of the policy. And all of that requires that we could actually have somebody called a contingent owner. All right. So who is a contingent owner? Or we call them a successor. So a contingent owner or a successor is in the case that the policy owner passes away before the insured, or we call it predeceased, the insured, then the contingent owner or the successor would become the new owner. If the policy owner has not assigned any contingent owner or a successor and they pass away, then the court has to decide who is the new policy owner. It's not necessarily the insured. Why? Maybe the insured is a minor or is not financially eligible to actually take care of this policy. So that is where, so if there's no contingent owner or no successor for the policy and the policy owner passes away, the court will decide who is the new policy owner. Basically, it's going to be your probate court because this is an ownership of the deceased person. So it's going to go just like any other asset inside the estate, and the probate court is going to assign a new owner, just like how they assign new ownerships for all the other assets. There's going to be a new owner for this as well. All right. So this is one thing that's really important. Contingent owner or successor. So they're going to be responsible for taking care of the policy, paying the premiums, making sure that everything is in place. One thing that the contingent owner or successor can never change is the beneficiary. So contingent owner and successor never have the right to change the beneficiary. Let's say Peter was a policy owner, Lucia was the insured, and the beneficiary was Jack, their son. Okay. Peter had a successor, which is his brother, which is David. Okay. David cannot remove Jack. Jack will still remain as a beneficiary. We cannot change the beneficiary. All right. This is the most important. Now, remember that the beneficiary is the most important part of any insurance policy. It's the one that's going to get the death benefit. So you have to be really careful about this. Now, let's say in another scenario, all right? Let's say in a scenario that Peter actually decides to insure Jack when he is still 10 years old. And he would put the beneficiary as Lucia, all right, the wife. And Peter says, okay, well, I want to start young for my son. I'm not thinking about him passing away, but, if unfortunately it happens, or, also it's cheaper right now, so I want to do it right now for him. All those good stuff. Or maybe like there's an investment portion in it and stuff like that. So Peter is the policy owner. Jack is the insured, and beneficiary is Lucy. So who assigned Lucy as a beneficiary? It's obviously Peter, because Peter was a policy owner. Now Jack turns 16 in Ontario, and Peter decides to change the ownership to Jack. All right, says, okay, Jack, you're 16 years old till now, right now, and you are eligible to become your own policy owner. I don't want to take the responsibility anymore. It's going to be your policy, whatever you want to do. So what is Peter going to do? He's going to assign the policy to Jack. So assign or assignment means changing the ownership. So whenever a policy owner changes the ownership, they call it assign or assignment, assigning it to somebody or assignment. And in this case, Peter has decided to assign Jack to the policy. What will happen when an assignment is occurred? The first thing that happens is that Lucia is not the beneficiary. Beneficiary will be waived if the assignment occurs. Remember, this is different than the successor owner or the contingent owner. In that case, Peter died. and the contingent owner and the successor owner has no right to change the beneficiary. In this case, there's an assignment. So Peter is still alive. He willingly is changing the ownership and giving it to Jack or whoever else he wants to do. All right. But when they do this, automatically the beneficiary is going to be waived. So who is the beneficiary if there is no beneficiary assigned? Let's say, and this is a really important question that comes in the exams. Let's say Peter does this, okay? And Jack does not assign any other beneficiary. 4 months later, Jack passes away. If there is no beneficiary assigned in any case scenario, the insured's estate is the beneficiary. It's not the policy owner. It's not the family members. It's always the insured's estate. So remember this. If there are no beneficiaries, the money will go to the insured's estate. If there's no beneficiary assigned. Okay? So what did we learn here? That the assignment, changing the ownership, will remove the beneficiary, whoever that person is, and the estate is going to be the new beneficiary until Jack decides, or the new owner decides to assign a new, basically, beneficiary. All right? So two really important things. Talking about something else that's really important. How many insured people can we have? We could actually have up to 2 insured people, which we call them the joint policies. So in a joint policy, which we have 2 types, we have the joint first to die and the joint last to die. Usually it's purchased between 2 partners in a business or between spouses. Let's say if they have a mortgage and this husband and wife decide to purchase a policy that if either one dies, the mortgage is going to be paid off. So in that case, they will purchase a joint first to die policy. A joint first to die policy means that whenever the first partner passes away, doesn't matter if it's a husband or wife, the second or the survival spouse will actually get the money. So let's say if it's between Peter and Lucia, Peter passes away, Lucia will get the money. The joint last to die means that whenever both people pass away, both insureds pass away, then the money will be given and will be, paid out. So let's say if Peter and Lucia decide that whenever, they both pass away, there's going to be enough money for Jack. All right. In that case, Jack is going to be the beneficiary. But if Peter passes away, there's going to be no money given out. Lucia would have to pass away as well until Jack will receive the money. So we could have insurance policies that there are 2 insureds under that same policy. We could actually have 2 owners in a policy as well. All right. So let's say if 2 children decide to insure their mother, their 60-year-old mother, they can both do that and become the owner of that policy. All right. So this is another thing that's really important. Let's dig into the beneficiaries. First of all, who could actually become a beneficiary? This is really important. Beneficiaries could be an individual person, could be a business. Let's say if I have a business and I'm worried that if I pass away, who's going to take care of all the liabilities, all right, and all the debts. So I purchase a policy. I'm the policy owner. I'm the insured, but the beneficiary is my business. In some cases, which we're going to talk about it later on, the business could actually purchase a policy. So the policy owner is the business, the insured is me, and then the beneficiary again is the business. I could assign a charity as a beneficiary, or I could actually assign my estate as a beneficiary. All right. So I could say that, okay, I'm going to purchase a policy on myself. So I'm the policy owner and the insured, and I'm worried about my taxes, my some debts and mortgage and all of that. I want to make sure that all of those are paid off in my estate. So I'm actually going to assign my estate as the beneficiary, which is going to pay off all those debts. So beneficiary does not necessarily mean that it has to be a person. It could be a business, charity, or estate. It could be, maybe up to 4, 5, 6 people. So you can give them each different portion. Let's say like I'll give 20% to my wife, 20% to my daughter, 20% to my son, and 20% to a charity, whatever. All right. So we can actually divide it as well. Beneficiaries. We have primary beneficiaries and contingent beneficiaries. Now, this is something that's really important. What does it mean to be primary or contingent? So primary beneficiary, well, let's give an example. Let's say Peter is the policy owner. Peter is the insured as well. And Lucia is the primary beneficiary. Okay? But they would assign Jack as the contingent beneficiary. So what does that mean? Let's say if Peter passes away, Lucia is going to get the money. But what if Lucia passes away sooner than Peter? Or what if they pass away together? In that case, Jack will become the primary beneficiary. So let's say if Lucia passes away before Peter, then Jack is going to become the primary beneficiary because the primary beneficiary passed away sooner than the insured, and Jack will now receive the money. Let's say if there is no contingent beneficiary and Lucia passes away before Peter, then obviously Peter's estate is going to become the beneficiary if he passes away. So let's say in this case, if I don't have a contingent beneficiary and I only had a primary beneficiary, and my primary beneficiary passes away before the insured, in that case, if the insured passes away without assigning a new beneficiary, the money is going to go to the insured's estate. Now, let's look at this case. Let's say Peter and Lucia were in a car accident, involved in a car accident, and after the biopsy and everything, they figure out that Peter passed away, or let's say they figure out that Lucia passed away sooner than Peter, all right, in 2 minutes or 5 minutes. Lucia passed away on the scene, Peter passed away in the hospital. So Lucia passed away sooner than Peter. So when Lucia passes away, then Jack is going to become the primary beneficiary. And then when Peter passes away, that is where the the money goes to Jack. All right. But let's say if the biopsy happens the opposite way, Peter passes away right at the scene, and then Lucia passes away in the hospital. What is going to happen? Because Peter passed away sooner, then Lucia is the one that's getting the money. All right. And because Lucia is the one that's getting the money, now, even though that Lucia passed away, but that money belonged to Lucia, all right, as a primary beneficiary, and it's going to go to Lucia's estate because Lucia owned that money. And now that she passed away, that is a money without any designation. It's going to go to her estate. So remember, if the primary beneficiary passes away sooner than the insured, there is a contingent beneficiary, the contingent beneficiary will get the money. If there's no contingent beneficiary, the insured's estate will get the money. If there was a contingent beneficiary and the insured passed away sooner than the primary beneficiary, the primary beneficiary will get the money. And if they pass away, then it's going to be their estate. No money is going to be given to the contingent beneficiary because it was the primary beneficiary's money. They're still alive when Peter passed away. All right. And the third thing that we need to talk about is called revocable or irrevocable beneficiary. All right. So what is a revocable or irrevocable beneficiary? A revocable or irrevocable beneficiary means that can I change the beneficiary or not? So who assigns the beneficiary? It's the policy owner, right? If I do it as a revocable beneficiary, the policy owner is allowed to change or remove a beneficiary anytime they want. But as an irrevocable beneficiary, you will need the beneficiary's consent to make any changes to the policy, even if you want to cancel it, if you want to add another beneficiary, if you want to do anything to that policy, the irrevocable beneficiary has to approve it as well. So let's say in a case that Peter, didn't get any better, sorry, Peter is a policy owner, Peter is the insured, and Lucia is an irrevocable beneficiary. Now, Peter and Lucia get into a divorce. Obviously, Peter doesn't want Lucia to receive any money when he passes away, but he is not allowed to change the beneficiary unless Lucia gives the consent. All right. So that is what's the difference between revocable and irrevocable beneficiary. All right. Okay. Now, this means that if Peter wants to assign the policy to somebody else, again, it needs Lucia's permission because we talked about it that when an assignment happens, the beneficiary is waived. So obviously, Lucia has to approve that assignment as well. Now that we talked about this, I want to talk about something called, well, it's not called anything. We'll get to there. But you know that we always talk about it, that life insurance is tax-free, right? And it does not, and it's creditor protected, right? It's not going to be seized. But that's not always the case. There are actually four different scenarios that would make a policy probably not tax-free and creditor protected. The first one is the preferred beneficiaries. If your beneficiary is not a preferred beneficiary, that money could be seized by creditors. Who are the preferred beneficiaries? It's your parents, your children, your spouse, and also your grandchildren. So your siblings are not a preferred beneficiary. Your friends are not a preferred beneficiary. Let's say if the policy owner or the insured assigned their siblings as a beneficiary and also they had some debt as well, there is the possibility that the creditors can seize or claim that money before the siblings get it. All right. So it's not going to be creditor protected. Second scenario is when the policy owner is the same as the beneficiary. So let's say Peter has insured Lucia. So Peter is the policy owner, Lucia is the insured, and again, Peter is the beneficiary. In that case, if Lucia passes away and has some debt, maybe Peter will not get the money because it's not credited. Third scenario is when the beneficiary is the estate. In that case, it goes to the estate, and obviously it could be taxable and seized by creditors. And the fourth scenario is if the insured actually owes money for spousal or child support. So let's say Peter has to pay spousal support, has to pay child support because of the divorce, and he has fallen behind. There's no other money that he has. He passes away. Let's say the beneficiary is his new wife, Mary. Even though that is a preferred beneficiary and it's creditor protected, but because Peter was fallen behind his spousal support and child support by the court, mandated by the court, then they would first take out that portion out of the death benefit and the remaining will go to the new wife. All right. So this is really important. So there's four times that um, the death benefit might not be tax-free or creditor protected. If they're not a preferred beneficiary, if the policy owner and the beneficiary is the same person, if the beneficiary is your estate, and if that person owed money to spousal support and child support. Sometimes the court says, yeah, you have to pay spousal support, but it's not mandatory. Or the ex spouse says that I don't want it. That is different. Okay, so remember that. All right. And the last thing that I want to talk about here is insurability interest. Now, this is something else that's really important. So insurability interest means that if you want to purchase a policy for somebody, you have to have an interest in that. So let's say if Peter, let's say Peter wants to purchase a policy on Lucia's life. Lucia is his wife, so he has an interest in Lucia's life. And if Lucia passes away, there's going to be a financial burden on top of the family. So obviously, Peter would like to purchase an insurance. But let's say if Peter and Lucia were divorced, and Peter wants to still buy a policy for Lucia. In this case, there's no bonding between them. There's no tied relationship between them. It's not important for Peter anymore that Lucia is alive. So maybe he won't be able to purchase a policy on Lucia's life unless there's again an insurability interest. Let's say if they have Jack as their son, and Peter wants to make sure that if Lucia passes away, there's enough money for Jack. All right. So that's that case. Remember, let's say Peter and Lucia are still married. Peter purchases a policy for Lucia, and then they get divorced. The policy is still in force because the policy is always approved based on that current situation, the initial situation. It doesn't change whatever the circumstances change. All right. So even if they get divorced, the policy is still in force unless Peter wants to cancel the policy himself or change the beneficiary, whatever. So I can't just go into the street and just start insuring everybody. There should be an insurability interest. It could be because of business, because of, divorce, or because of marriage, or it's your children, or something like that. Other than that, you do not have the insurability interest in it. All right. So that's something else that's really important. You have to have an insurability interest. All right. Let's talk a little bit about the agents. Now, when we talk about agents, we have two different types of agents or advisors. One are called captive agents, and the other ones are called independent agents. If you only work for one insurance company, like you're an employee for them, let's say if I only work for TD Insurance, or I only work for RBC Insurance, or I only work for Manulife, and I don't have access, and I'm not allowed to sell, multiple different type of insurance policies from different companies, then obviously I'm called a captive agent. But let's say I want to be an independent one, so I could be working with different type of insurance policies and insurance companies, basically like a broker. So this is where it kind of looks like the difference between a taxi driver from the airport or Uber. So an Uber driver can, basically independently drive anywhere in the city, pick up or, decline to pick up somebody and stuff like that, or work any time of the, day and stuff like that. But there should be some regulations. There should be some criterias to requirements to make sure that this person is eligible to actually work as an Uber driver. So although that Uber does not own that driver, is not hiring that driver or the car itself, but they have provided a platform and they have made sure that the client, the driver has a driver's license, their car is, safe, they have insurance, they have blah, blah, blah. There's no background, criminal things or stuff like that. And then they're allowed to work any way they want, okay, and sign contracts with different insurance companies. So independent agents, they need to be exactly under a platform or an organization, just like Uber does for drivers, that they can monitor and make sure that these people are legislated and they're, uh, allowed to do business. And these organizations are called MGAs, Management General Agents. So Management General Agents, MGAs, are these organizations that they do not own any policy, any type of insurances, products. They're not going to own you or employ you. Basically, you're not their employee. What they're only going to do is they're going to make sure that you know, have all the requirements to work as an advisor. All right. So WFG is an MGA. They are not an insurance company. All right. Now, last but not least, let's talk about some really important points, and then we're done with this slide, with this understanding insurance. We talked about it, that we said a policy is in force in two situations. Like two situations have to be implemented and done until we can say a client is insured. And that is signing the delivery signature that we talked about it here, plus paying the first premium. So let's say if the agent goes to get the signature and the client says that, let's say today is June 1st, okay? And that's where the delivery signature is going to happen as well. And let's say the client says, okay, start taking the money out of my account from June 10th. So from June 1st to June 10th, the client is actually not insured. If the client passes away on June 5th, the client is not insured. There's not going to be any death benefit because the first payment has not been paid. All right. So this is really important. First premium has to be paid, and also the delivery signature. Let's say if the client gives the money right away, gives a check to the advisor along with signing the delivery signature, the delivery receipt, and then the agent actually neglects in giving the delivery signature and the first premium check to the insurance company. Now that is the agent's fault. So in that case, if it's the agent's fault, the agent has to pay the insurance, the death benefit, and that will be paid by their E&O. So E&O is an insurance for agents. You have to have an errors and omission insurance, which basically means that if the agent has made any mistake from the beginning to the end, doesn't matter if it's just this case that I talked about, and the insurance company is not going to pay for it, and it was the agent's fault that something happened, then E&O is going to protect the agent and they're going to pay the death benefit. Let's say in the application, the client did mention that, okay, I do have, cancer. And the agent accidentally puts in no for cancer, right? It gets approved, everything is done, and then the client passes away. The claims department of the insurance company digs in more, understands that there is, basically, there was a cancer. In this case, obviously, the agent is responsible for, not capturing the right answer and stuff like that. And obviously, the E&O has to pay for it. Or let's say if the agent um, misrepresents some information about the policy, again, it's the agent's. So overall, this is really important. Um, so the policy is enforced when we get the delivery and also the delivery signature and also the first premium. Um, so what if, so obviously the client is not insured when they filled the application. They're not insured when the application has been submitted. They're not insured even when the underwriter gives the approval. All right. What if the client passes away during this time? What if the client passes away when they didn't sign the delivery signature yet, and they have been approved? Or even maybe they still haven't been approved. It's still under review. In this case, we have something called TIA, Temporary Insurance Agreement. When you are submitting the application, you can request for TIA as well, Temporary Insurance Agreement. And in that case, this whole process well, I'll remove this, but that whole process is going to still insure the client, even though that they're still not approved. So it's a temporary insurance. But there's a couple of requirements. First of all, you should not be leaving North America. Second, you have to pay the first premium right over here. So when you're submitting the application, you pay the first premium as well. There's going to be a couple of extra medical questions that you have to answer no to all of them. If you answer yes to one of them, you're not going to be eligible for this. It's only valid for 3 months. So if the underwriting process takes longer than 3 months, then the client is not insured. And also must be over 18. So we cannot do this for a 5-year-old or a 10-year-old, the TI or the insured, right? So if a client is not leaving out of North America, pays the first premium at the time of submission, answers no to those medical questions, then they are insured until either the underwriter declines them or until the delivery signature comes in and they're officially enforced. TIA is usually up to a maximum amount. So let's say if you insure yourself for $5 million, it doesn't mean that your family will receive the $5 million if you pass away during the TIA time. It might be a portion of it, usually up to $400,000. And let's say that the client actually signed the policy and everything and paid the first premium, and then has a review on the policy and decides to cancel it. When is it going to be subject to a penalty? And when is it not? So a policy can be canceled without any penalty for the client up to 10 days after delivery. So let's say if the client, signed the policy on June 1st, they have until June 10th to make a change to this policy or cancel it and get their premium back. All right. So I think this was a lot of information. I'm sure it took more than 1 hour, but now you can understand exactly how an insurance application works. Who is the client? Who is the agent? Who is the insurer? Who is the underwriter? Talking about the policy owner, the insurer, the beneficiary, and all of that. Now, a lot of parts go into the ethical part, which we'll talk about, and in the ethics. Some parts go into the life insurance part, which we'll talk about it in that part, in that module. But overall, now we know the A to Z of an insurance application. Who is a beneficiary? Who is an insured? Who is a policy owner? What type of agents we have, and so on. All right. I hope that this was informative and it helped you guys a lot. After this, you should be studying life insurance module. Take care.